All right, Ernest, I can see your presentation perfect, and I'm going to turn the floor over to you.
Great. Thanks, Michael. And just want to extend my good wishes to everybody. Hope that you and your family, your friends and colleagues are safe and well. I think we've all been impacted by this virus, both physically and emotionally, and not to mention financially. But we're going to get through this. And again, our good wishes to everybody that's suffered any kind of setback through this. So what I wanted to do today is, I'm not going to so much pitch our fund, and Michael and I have been talking about this, but really kind of go through our business thesis and the underlying facts and filters that we put on to give our outlook of what we think is going to be happening out in one sector of the multifamily environment. And I'd start off by saying, and I think this echoes what one of the previous panelists said, is we believe there's two buckets of owners out there right now. I think there are the companies like many of the people that were on the previous panel and that will speak today, and I like to put our company in that group as well, that we have our properties well stabilized in terms certainly of occupancy, but more important, our capital stacks behind the properties are strong. We have patient money, we have good debt. I just saw a report from our asset management group. We actually have 9 of our properties where our interest rate is less than 2% this coming month, and our overall portfolio average is a tick over 2.1. So we could actually lose about 30-something% of our revenue and still hold on to our properties because of the capital stack. And I think a lot of other owners are in similar situations. But then I think there's the other group of owners that maybe just wrong place at the wrong time. They're going to need to sell, and they're going to need to do something. And so the overriding thesis for our fund is we don't believe that we're going to be out buying distressed properties. Rather, we're going to be trying to find properties from distressed sellers. And we'll cover that a little bit more, but that's the thing to keep in mind. And I'd also equate that to, as we've talked about this crisis and how it compares to other crises we've seen in the past and how it's impacted real estate, and I'll show you some statistics in a minute. I think the best example I can give, and I know we've got a lot of people from Florida, and a lot of people in Florida like to fish, and they like to big game fish. But there's a couple of ways to fish. And out of the Asian countries, they have these big commercial fishing fleets with these big boats, and they put these big long drag nets back behind the boats. I mean, these things are miles long. And they literally just catch everything they can and throw some away, keep some, freeze some, etc. And that's one way to fish. Another way to fish is to go for the trophy fish, the marlin, the billfish. And you get on your 52-foot Viking sport fisherman, you get the right crew, you get the right equipment, and more importantly, you know where to go fish. Well, I think that the people that are forming some of these larger funds, especially if they're oriented towards multifamily, are going to be disappointed when they put those big drag nets out there, because I don't think there's going to be that many properties out there. On the retail, some office, some certainly in the hospitality, maybe that's a different story. Anyway, so that just kind of gives you an overall idea of what we were thinking. That we think that because this is an event recession versus a cyclical recession, I agree with what some of the other panelists have said, is there just wasn't the overbuilding, and there is still a severe shortage of housing in our country. So therefore, we don't think the discounts are going to be very significant. We think you're going to have to choose your markets well. And again, we think the focus is going to be on distressed sellers, not distressed properties. So with that, I'll jump into some of the information that we're sharing. And this fund has been launched. In fact, we opened it last Friday. We already have some significant subscriptions to the fund, and we anticipate we'll have our first closing at the end of the year as we see properties. So our disclosures. Again, the basic thesis here is that we're trying to capitalize on pricing dislocations in the sector created by the COVID-19 pandemic and the ensuing economic crisis. And the information I'm going to share with you is that apartments, they're sustainable, they're not recession-proof, but historically and significantly have outperformed the other real estate sectors that we'll see. So here's what you're going to see in the next few slides, that multifamily tends to be the last sector to experience a rent decline. It has the shortest period of rent decline. It's the first sector to recover to pre-recession peak. It then has the longest duration of rent growth from post-recession recovery until the next recession. And then multifamily has just experienced the longest run of sustained rent growth of any real estate sector. So let's look back at the last couple of recessions. This is the recession of 2001. And looking at the three of the primary food groups, multifamily rents declined 6.7%, industrial 7.4%, office dropped by 17%. And then once the rents recovered to their pre-recession peak, multifamily grew by 10%, industrial 4.3%, and office 5.7%. This next slide gives you the time frame. So again, we said that multifamily has the narrowest or the shortest amount of time in decline. It was 9 quarters versus 15 and 13 for industrial office. It only took 7 quarters to climb out of the recession back to its pre-recession peak, and then it grew for 12 quarters thereafter, and the other groups lagged a little bit. So again, strong recovery in multifamily. If you look at the 2008 and 2020, a little bit different. We've brought retail in here as well, and I'll explain that in a second. But again, you see multifamily drop the least compared to industrial, office, and retail. And then its recovery was extraordinary, 25.7% rent growth since the last peak to where we are in 2020. The interesting aspect about retail is very interesting is retail rents today, on average, they're not where they were in 2008. They are still below 2008 rent numbers. And a lot of that is just the impact of e-commerce and how people are buying and what they're doing in the demise of some of the big box trades and the regional malls and the troubles they're having, et cetera. So it's just an interesting comparison of how these markets are working. And then again, here's the time frame. Multifamily only had 5 quarters of negative rent. Now, again, if you think back about what was happening in 2008, we did not have a significant oversupply of multifamily properties being developed. This was back in the era, if you could fog a mirror, you could get a loan, you could buy a house, interest rates started rising, people lost their house. There was a lot of single family homes dumped on the market, and a lot of those people came into multifamily. As multifamily started filling up, the rent decline stopped, it grew back, and then we had 29 quarters of rent growth until this recession. The other sectors did not fare as well. And again, I think this is indicative of what we see in recessions. And again, keeping in mind that we think this is an event recession, there'll be a quicker recovery. Multifamily rents begin to climb and actually climbs when we see job growth. Those are the 2 factors that correlate in our industry: job growth and rent growth and occupancy. So we think that this is a relatively short recession cycle that we're looking at, but there will be some opportunities. So this is an interesting chart, and I think a couple of people have alluded to this, is just the sheer decline in volume of real estate transactions. The line in green represents the great financial crisis, leading up to 2008, and blue represents the current downturn. So as you can see, both of them leading up to their peak, they were running very similar. Transactions about the same, year in and year out, even though it was, 10 years later. The transaction volume peaked in June of 2007 during the great financial crisis, or leading up to it. And then it was kind of a gradual downhill slope that you saw that took about 20 months to bottom out in January of 2009. And that's when a lot of the really good buying opportunities came. But here you can see what's happened. We had a peak of activity in January 2020, and then in a 3-month period, our volume dropped 87% versus an 80% decline over almost a 2-year period in the previous recession. A lot of people have asked what caused the spike in 2020. And I think there's a couple of things that happened. One, there was an inordinate amount, and still is, of dry powder in our sector. There always tends to be a rush of activity at the end and the beginning of the year. By January, we knew something was happening in China with this virus, and there was a thought that it was going to impact the financial markets, that there might be a drying up of debt or other things. Interest rates were at a pretty good price at that point. So there seemed to be just an acceleration of closing on transactions. Even sellers, thinking that something bad was going to happen, started dropping prices a little to try to get that transaction closed so they wouldn't have to hold on to it. So there was your big spike. And then there is your big drop that followed thereafter. So what we're thinking is that this is when the buying opportunity is going to start. And we've actually seen that. Just to give you a couple of anecdotes. The 2 things that we've been doing following the beginning of the slowdown back in March. One, we've been doing a lot of research, and I'll show you a few bits of that in just a minute, trying to really understand why our sector was doing so well. And then to try to put some objective numbers on that, some quantifiable numbers. and then apply some subjective filters to help us understand what the markets were going to look like post-COVID-19. What was our new world going to be? What was going to be important to residents, to investors, et cetera. The other thing we started doing was we took our investment thesis and went out and started talking to literally all the brokers that we know that we've been buying properties through the last couple of years. And, you know, these people, these men and women, you know, their world has gone dark. They have very few transactions. So when, you know, my chief investment officer, Tim Burns, calls the broker down in Jacksonville and says, hey, I'm going to be there Wednesday. You want to go have dinner? You know, Bob is ready to leave the house, go have dinner, go talk, do everything. And so it's been really interesting that they've all embraced our thesis and like our idea. You know, same thing, it's going to be selective purchases. And we've told them we don't have the fund up and running yet, but we want to start seeing deals, you know, hearing things, you know, keep us informed. And one of the gentlemen before said the opportunities have not, you know, yet happened. We've actually seen some of these deals. I don't think you're seeing them broadly, but one of the things that we've come to realize, and this ties in with what some of the other panelists said, is that the current owners that are going to have stress, they can hold on to their properties longer. They can use forbearance. They can work with their debt. They can do a lot of things, but sooner or later, you know, the chickens are going to come home to roost and they're going to have to do something. And so what we're finding is that they don't have the 4 to 8 months to go through the traditional cycle that it takes to sell one of these big multifamily properties. They call the broker they know, or they call people like us and say, hey, I've got a situation. I know you guys have cash. I know you've got debt. You know, can you move quickly on a deal? And so we think a lot of the deals are going to be what I'm going to call a quasi off market. And to give you an example, we've been looking up in the Little Rock, Arkansas market for some time. We knew the part of town we wanted to be in, the Chenal Valley, and we kept getting priced out of the market. We couldn't quite get the returns we wanted. Broker that we had been meeting with, that we've done a couple of transactions with, called us on a Wednesday midday and said, hey, I've got a client that needs to move a property. How soon they need to move it? We need offers by Friday. How many people are you talking to? Well, I told them you guys were probably the right buyer, but they said I need to talk to 3 other people. You know, so we knew the property because we'd been up in Chenal Valley. We toured this property. We understood it. We had the rent rolls. We, you know, looked at a lot of the demographics. And so we made our offer on Friday. We were told we were not the high bidder. We were $500,000 below the high bidder. We had seller interviews on Monday afternoon at 6:30. Went through our process. We showed them we have the money available. We know the market. Here's our underwriting. By the way, we're a select sponsor with Freddie Mac. We've got cheaper money than anybody. We've got a team in place. We're pre-approved. Yes, we can close quickly on this deal. At the end of the call, what happens on these buyer-seller interviews, typically the seller says, well, Ernest, thanks very much. We'll get back to you in a couple of days, which is code for if you want to raise your offer, you have 2 days to do it. And at the end of this call, the gentleman turned to the broker and said, you know, you were right. These are the right buyers. We accept their terms. You know, let's move forward to contracts. So we're closing on that deal October 1st. So that was about a 5-week total transaction. We think that's indicative of the things you're going to see. But just by being out there in the markets, you know, like a lot of, you know, my competitors or compatriots here, the value of being out of the market in front of brokers is invaluable. So that's where we think the opportunities are going to come. And then the question is, what does the recovery look like? This chart looks a lot different. This is basically supply and demand. The bars going up and down is demand, and the vertical, I'm sorry, the little squiggly blue and green charts are supply. The green chart is the gross number of new completions, and the blue is net completions. Our industry loses about 75 to 125,000 units a year to obsolescence. Units that burn down are developers that come in and buy existing properties and then build a new property where the old one was. So the net number is what we really look at. And you can see we've really been tracking really well. In fact, supply has been demand has been right at or exceeding net completions the last few years. But the other thing that we've seen is with the pandemic, any project that's underway is going to be completed. No problem there. They're going to finish. The developers are going to make their fees. They're going to do whatever, you know, they can. But what we're seeing is that debt and equity for new development has pretty much dried up. And so we think there is going to be a significant slowdown. I've heard 50%, I've heard 75%. So somewhere between those two numbers is probably the truth. And once development stops, it then takes about 2 years or 3 years to get it started back again and to be as robust. And an example of that would be, if Michael and I decided to go build a project in Austin and we found a piece of land and then started the project, it would take us about 2.5 to 3 years before we were probably in construction because of all the regulatory issues we have to go through. So it takes time to ramp back up. So what we're seeing, if you read the tea leaves, is we think there's going to be an opportunity to buy some properties in the next 12 to 18 months, ride that recovery. Again, the economists that we have on retainer all seem to indicate that they think we're going to get back to 96, 97% occupancy by the end of 2022. We're going to see 5 to 6% rent growth, and then you start having the development come in. So our thought is that we can buy these below replacement cost or at a discount, and we can either then finance out and get money back to our investors and hold on some cash flow, or at that point, the institutional investors are coming back into the market to buy, and we can be selling them properties as well. And so that's sort of the buy-sell timing on this fund. So that gives you an idea of supply and demand in our industry. So this now what we're looking at is the other thing I mentioned is you better make sure you're buying in the right markets. And I've heard this echoed in the last couple of panels. And I mentioned that one of the things that we did was to do a lot of research. And I want to show you a little bit of that research. So one of the things we did, and I'm just going to switch to this other screen here real quick, Michael, I think it'll show up. So what you should be seeing, Michael, is a Excel spreadsheet.
Yes, that's correct.
Okay. So what we did is we went through every county in the United States. I think there's 3,140 counties in the United States. And we started looking at definable demographic information, hard data that we could pull down, wasn't subjective, purely objective. And this is the sample. This is a massive grouping of spreadsheets where we looked at everything from income growth, how it ranked nationally, population growth, rents in the market, new deliveries in the market, GDP, just all these different variables, and started ranking the counties by these numeric numbers. And you get to these, so this is by counties, and then you kind of get to the rankings, and you have some weird anomalies, how they fall out. But what it really does is, it delivered this information and report, looking at, what was driving these markets also. And so we have our data now. We say, okay, what are the drivers? And so the first thing we looked at employment, and what employment has been dramatically impacted by COVID-19. And these were some of the sectors that everybody's identified, nothing new there. We then started breaking it down by large subsectors. And what we were looking for were the subsectors that had huge impact, and then those subsectors that had the smallest losses of jobs. And if you were in one of these counties or communities that had the smallest loss, like federal government or state government, you got a point in your scoring. We looked at median subsectors. Clothing and retail stores had a big loss. Couriers and messengers, not as much of a loss. Small subsectors, sites, just little things. And these were all from the Bureau of Labor Statistics. So then we started, looking at other things that we would work into there, such as what happens with rent payments after the federal subsidies dry up in July or whenever they do. How much money would a family have left over after paying rent if they're relying on their state unemployment funds? And so these were some of the markets and some of the things that came out. So then what we took and said, okay, we think that the markets that we see are going to fall into two broad categories: those fast recovering markets and the more opportunistic recovering markets. Faster recovering markets mean they're going to start showing significant recovery in 12 to 18 months. And slower markets are going to be, 2 years or more. And so, we started looking, and these were the 8 subjective filters that we started looking at: pre-COVID growth and rental demand. In other words, it was a good market before COVID. It'll probably be a good market after it, that theory. Diversified employment, no one-horse towns. Strong healthcare and medical facilities. People are very attuned to that right now, not to mention that those are big job drivers, and those people did not lose their jobs during the pandemic. Stronger state unemployment funds. This was important for 2 reasons. One, we wanted to make sure that the states had the money to sustain people through an economic downturn. And 2, they had a good methodology to replenish those, not just dump high taxes on real estate. I think some of y'all may have seen in Nashville, they've increased real estate taxes by 35% on commercial properties to try to recover some of the losses that's been incurred. So, we're looking for stronger state funds. Research, technology, innovation hubs, and universities. Again, these are big, major employers that ended up being, very resilient in terms of the COVID-19 rankings. Ease of access and transportation, major transportation hubs, airport, freeways, getting in and around the cities. Climate, always a big scoring plus in markets. And then managed supply. I mentioned the example of Austin, where it's very difficult to build, whereas you can go up to Lubbock, Texas, and we can probably have a project underway in a month. It's just, that different. So those are the filters we looked at. And we said, okay, so what does that mean? And so this kind of became we call it our amoeba. We started looking at the various, rankings that we just listed and say, okay, what cities fall into those? And just run around a couple of them real quick. Strong healthcare, Houston, Texas, the largest medical center in the country, arguably the world. You see the other cities on there, previous high growth cities, Orlando, Las Vegas, Reno. Austin jumps into that one again. Research and technology, there's the research triangle, Raleigh, Durham, Atlanta, Boston, Austin. Huntsville, Alabama, my hometown, we have more PhDs per capita than any town in the country, and that's because Werner von Braun launched the space program in Huntsville. A lot of y'all probably sent your kids to space camp there, but it's emerging as the new Austin. And I say that tongue in cheek because it's like everybody wants to be the next Michael Jordan. Every city wants to be the next Austin, Texas, but Huntsville is clearly emerging as that. Logistics and transportation, Dallas and Atlanta, known for their world-class airports. Memphis, the geographic center of the United States, there's a reason that Federal Express is located there. Cities with unique characteristics got a score. Orlando, Disney, Universal Studio. The people that run Disney are incredibly smart. They've figured a way to get that place open. They're going to get people through there. They're going to do well. Las Vegas, Miami, the same way. Miami, I didn't realize this. I actually think Michael Corselli's wife may have told me this stat. Most people think of Miami as the gateway from Latin America, but the most transactions in condominium sales the last 2 to 3 years have been people coming in from Europe and Eastern Bloc countries. Well, that's all dried up right now, but it will rebound. And then New Orleans, of course, is the #1 convention town in the country. And then this other sector, COVID resiliency. These were towns that proved to be somewhat resilient to COVID-19 from an economic basis. So these were these towns that had those large economic drivers that we talked about that just did not have the major job losses, and you'll recognize the towns there. So from that, we filtered out, our Santa wish list. These are the faster recovering large markets and what their primary drivers are. So, again, you see some of the usual suspects, and then on the right, you see what kind of points they earn by being in that particular sector. We looked at some of the smaller markets because we traditionally invested in small markets and we like these. And so there are some characteristics of the quote smaller markets that are out there. Birmingham, Alabama, we bought a property in Birmingham in May during the pandemic. It was right next to the hospitals. There's like 6 big hospitals in Birmingham. There's more state employees in Birmingham than Montgomery, and Montgomery's the capital. It has a lot of insurance type companies. It's logistics and transportation capital. And so, it got points for those areas. And so then we looked at, I mentioned the opportunity markets, the markets that would be recovering longer. What were their characteristics? The same as the fast recovering market, but they had a much steeper impact to employment on COVID-19. Great example I can give you is we had a property under contract in Jacksonville, Florida. We did not execute on that because over 40% of the employees were in the retail, hospitality, restaurant type business, and we thought there would be some vulnerability with that rent roll. So we passed on that, but Jacksonville's a market that will recover. Historic performance and unique characteristics, and then boom, here you see kind of our top 5 cities that we identified for opportunistic markets. So that shows you the kind of research that we were doing to come up with what you're now seeing as our grade 8, and you see the cities behind there with the large circles behind them. And then this is just to wrap up real quickly. The other thing we ask ourselves is how much is prices going to have to drop to make, to generate the kinds of returns to investors? And we're targeting 16 to 18% returns net to our investors and a 2 to 3 multiple. Following the 2008 recession, you saw prices in real estate drop by about 35%. We didn't think that was going to happen this time, but we want to know, okay, how, where do we have to be to get these kinds of returns? So, These two charts represent the comparison of a base case deal, a property that we bought in December of last year, and we discounted it by 5% and then 7.5% and 10%. And then the chart on the right takes into account if we bring in a joint venture partner. So basically at a 5% discount to that pre-COVID pricing, we hit about a 15% IRR, but we hit our 2 multiple, a 2.1, 2.2 multiple. At a 10% discount, we're looking at about a 17.5 return and about a 2.6 multiple. Also keep in mind, we dramatically changed our underwriting standards for properties. We moved our occupancy down to 88%. We had relatively no occupancy increase over the 2 years. We used flat or negative rents, and we put a 6-month reserve at each of these properties to cover all of our operating costs, debt, et cetera. And so we call it our draconian underwriting. When you switch to the screen to the right, and this would be bringing in a joint venture partner, and we've done 40 joint venture partnerships at Apex One. And this is assuming that we would put up 40% of the equity, and this mirrors a deal that we've done repeatedly. We put up 40% of the equity, the partner puts up 60 and 8% preferred return. Once we pay the 8 pref and return all capital, we switch, and here you can see that the returns dramatically increase under that. So just to wrap up real quick here, this is just some historical data on how funds performed from 2009 to 2011, comparing them. Now, again, remember that back then, there was not a lot of debt available. You sometimes could only get, 50% leverage, maybe even 60% leverage. And the cost of debt was more than twice what it is today. So that kind of brought these returns down. So what it tells us is basically at a 7.5, and 8 to 12 is the number we're hearing, but at a 7.5 to 10% discount, we can hit our numbers without having to have that big 35% drop. And so just in closing, and see if we have a few questions. I'm sorry, next slide here. So these are the properties we're looking for that we think are going to be available. Assets with inadequate capitalization, which can be acquired below replacement costs. Again, distressed sellers, not distressed properties. Assets in markets impacted by COVID-19 that we believe will have a strong recovery in the ensuing economic expansion. Properties in markets that have become overbuilt in the short term but have a clear path to rebalance. And then, of course, the ability to buy real estate debt, including performing and non-performing loans, so there's a clear path to ownership. So that's where we are on this. Here's some historical performance that people can look at. The fund, we noted here that it's $1 million minimum investment. That's for our larger investors. We've always waived that for anybody coming in off the FlyUp platform. We'd be glad to talk to you. The asset management fee is 1.25% on called capital, not committed capital. And during our investment period, for those that come in before our first close, we're actually dropping that to 0.75%. So there's some benefits coming in, and we have a 20% carried interest. So anyway, there's our team. We're here and ready to work, and there's our timeline. And Michael, I think that gets me right up pretty close to the time. But thank everybody for your time. And again, I would just echo what everybody else has been saying is I don't think there's just going to be an avalanche of distress in our multifamily sector. But I think choosing a good sponsor is a smart move. And I do think there is going to be opportunities for the smart investor and the smart money that's going to be out there.
Ernest, thank you very much. Thank you for your presentation today. It was fantastic. I love the data and the data that you went into. I'm sure the audience felt the same way. And as always, it's great to hear from you, and congratulations on fund number 4.
Thank you.
And congratulations on fund number 3 and how successful, that was for you. So is the presentation going to be made available? Because we have had a bunch of people asking for it. Is the presentation going to be available to the audience today?
Yeah, I'll certainly make this slide deck available to the audience. I think you have a copy of it on a PDF form, and you're feel free to share that. And then I think we'll also have a link through your marketplace into Fund 4 if anybody wants to click on that. Or here is my info. You may have taken it down already, but
I will share your
my contact
information with the group if they want to reach out to you direct. And then I'll also share a copy of the presentation as well as a recording of today with the entire group. So Ernest, thank you very
Thank you,
much.
Michael. Stay well, my friend.
Thank you, you too.
I know.
So with that said, just moving on here, I want to thank all of our sponsors. We have a really amazing group of members of FLIA. For those of you that are not members and are interested in joining, please reach out to myself or Jeremy. Um, I'm Michael at FLIA.org. Jeremy is Jeremy at FLIA.org. So with that said, I want to thank Sotheby's and Paula for being members of FLIA. And if anybody has any real estate buying needs, please consider Sotheby's as your source for good transactions. Our FLIA special market situations marketplace is up. I'll be going through a demo later today on that. If you haven't signed up for pot 7 through 9, please do so and add these dates to your calendar. If you're interested in speaking or sponsoring one of the events, please let us know. We do educational webcasts. They're 1 hour in length. We have a really, really good group of presenters coming up over the next, let's say, 6 weeks. S&P Global Market Intelligence put together a really senior group of people to talk about CRE and credit risk considerations for direct lending and private debt. That's happening next week on September 15th. Group RMC, a $2 billion asset manager on September 16th. Understanding this rare opportunity in real estate. They are in the office space. Prime Meridian. They basically buy loans off of platforms. They're going to give a current outlook and update on how things have been going since the whole COVID-19 has broken out, and they've actually done extremely well. Allagash, you heard from Tony Barkan earlier today. He's presenting on the 8th of October, Working Class Housing Opportunity Fund launch. JDM is going into distressed hotels. You'll actually hear a little bit from them today. EMQQ on October 20th, the future of emerging markets in the digital consumer revolution ETF. So if you haven't registered for these, please go to the FLIA website and sign up.